Our guest today at Money Show is Ingrid Hendershot, money manager, value investing expert, and editor of Hendershot Investments. Thank you for joining us.
It's my pleasure. Thank you.
Could you give us an overview of your investment strategy?
Yes, in a nutshell, our investment strategy is to invest in high-quality stocks at a reasonable valuation, which we can hold for the long term.
Awesome. So at the start of the year, you chose Alphabet as your favorite stock for 2017. Since then, the shares have risen 22%. Could you explain the original rationale behind choosing this stock?
Sure. Google is probably one of the strongest global brands in the world, and its core products such as Search, Android, Maps, Chrome, YouTube, Google Play, and Gmail each have over 1 billion monthly active users. And most of Google's products and services are free for users. So the majority of the company's revenues come from advertising, as Google's proprietary technology automatically matches ads to the content of the pages on which they appear. And thanks to the growth of the digital economy and the shift of consumers and advertisers from offline to online, Google has generated outstanding growth over the years, and that continued last year with more than 20% growth in revenues and earnings. And despite heavily investing in data centers, the company's robust free cash flows jumped 55% last year, with the company ending the year with more than $86 billion in cash. So that's our definition of a high-quality company: strong growth and a great balance sheet. They also announced a $7 billion share repurchase program, and so they're starting to share the cash with investors. So our advice was that long-term investors should Google Alphabet, a high-quality company with a strong brand, outstanding growth, and robust cash flows, and we were buying it at the beginning of the year.
Could you share an overview of developments at Alphabet since the start of the year?
It's pretty much more of the same. Their first quarter revenues were up 22% to $25 billion. Net income was up 29% to $5.4 billion, and earnings per share were up 28% to $7.73, driven by their strong advertising revenue. Their aggregate paid clicks jumped 44% during the quarter, and that's due to the explosion of mobile usage, where people are using their smartphones to do searches. During the quarter, Google also expanded their safeguards for ad placement by broadening the definition of inappropriate content and adding controls for advertisers, including the deployment of artificial intelligence to identify extreme content. Their other bets revenues also were up 48%, and that's driven by their Waymo Alphabet standalone driverless car unit, which has embarked on an early rider program where applicants accepted into the program can summon a Waymo driverless car via an app to go wherever they want in the Phoenix metropolitan area for free. And this is allowing Alphabet to collect reams of data about how driverless cars will be used in the future. The first quarter free cash flow, again, was up strongly, up 35%, generating $7 billion, and the company did buy back $1.1 billion of their shares. So they ended the quarter with $92 billion in cash on their strong balance sheet. So it's really no wonder that Barron's recently named Alphabet as the most respected company in America.
Given the stock's strong performance so far this year, do you still recommend it as a buy?
Well, we're currently holding Alphabet after a strong run-up based on 2017 earnings. But after the second quarter, if strong growth continues as we suspect and we roll our valuation model forward to 2018 and the stock price stays below $1,000 a share, we think it would still be a buy at that point.
This is Zach Levine with Money Show, and we've been speaking with Ingrid Hendershot, editor of Hendershot Investments. Thank you for your time.
Thank you.